All right, good afternoon. This is Group 8, and my name is Victoria Martinez.
I'm Anna Herrera.
Dennis Zamero.
Coker Lucas.
And Bianca Rivadenero. Okay, so good afternoon, everyone. Today we are excited to discuss Coca-Cola. Their stock symbol is KO. They are leading in the global beverage industry, and they are known for their iconic brand and extensive market presence. Our analysis will delve into Coca-Cola's financial performance and investment outlook. First, we'll talk about how we evaluated Coca-Cola's financial health. We use several methods, including residual income, market-to-book approach, and dividends. Our findings suggest that Coca-Cola's value per share ranges from $19.30 to $38.15. These methods highlight Coca-Cola's overall strong cash flow projections and their potential to continue to grow. As of the latest data, Coca-Cola shares are trading at $58.30 in the market. This price reflects a significant premium over our valuation estimates, indicating investor confidence in Coca-Cola's future performance and strategic direction. For our current shareholders, considering the premium in the market price, maintaining positions could capitalize on this confidence. Prospective investors might find potential entry points during market fluctuations to optimize their investments in Coca-Cola. However, it's important to understand the overall risk. Such factors consider changing consumer preferences constantly changing, and regulatory shifts could impact Coca-Cola's market position. Investors should carefully assess these risks based on their risk tolerance and investment strategies. Overall, Coca-Cola's strategic adaptability and global market dominance position is strongly amidst economic uncertainties, and investors should approach the entry into Coca-Cola stock thoughtfully. Considering our valuation insight and evolving market landscape, we'll go ahead and continue to discuss the overall Coca-Cola's profile and history.
Yes, Coca-Cola's profile and history. The Coca-Cola beverage started in 1886. It was invented by pharmacist Dr. John Pemberton in Atlanta, Georgia. And in 1892, businessman Asa Candler acquired the rights to Coca-Cola and then founded the Coca-Cola Company. Today, the Coca-Cola Company is a world-renowned beverage company with a presence in over 200 countries and is one of the largest manufacturers, offering over 200 different beverage products. The Coca-Cola Company introduced itself as a public company on the New York Stock Exchange on September 5th, 1919, with an initial public offering of $40 per share. Over the past 20 years, Coca-Cola's stock has fluctuated in price due to the market conditions and trends. However, it always stayed within a stable environment. And as of July 1st, 2024, the stock price was at $63.28. Now, when looking at Coca-Cola's strategy to understand their business, we looked through the Porter's 5 Forces framework. Through this framework, Coca-Cola can analyze the competitiveness within the beverage industry and implement competitive strategies such as cost leadership and product differentiation to gain a competitive edge. With the first force of competitive rivalry, this looks at factors of competition amongst existing companies within an industry. Some of these factors include the number of competitors, company growth, products offered, and costs. Within the beverage industry, Coca-Cola faces a high level of competitive rivalry due to these factors, and the biggest rival Coca-Cola has is Pepsi due to their similarities. For the threat of new entrants, this observes how feasible it is for companies to enter an industry. Coca-Cola faces a moderate level of threat to new entrants within the beverage industry, and the factors that influence this include brand loyalty, distribution networks, and regulation and investment requirements. For the threat of substitutes, this is when a consumer can find another substitute good or service to fulfill their needs better. Coca-Cola faces a moderate level of threat to substitutes, which can be influenced by factors including available alternatives, consumer preference, and health concerns. For the bargaining power of suppliers, this refers to the amount of influence that suppliers have over a company. Coca-Cola faces a low bargaining power of suppliers because of the company's size, presence, and reputation. And some factors associated with Coca-Cola's low bargaining power of suppliers includes the number of suppliers available and their switching costs. As for the bargaining power of buyers, this refers to the amount of influence buyers have over a company. Coca-Cola faces a moderate level of bargaining power with suppliers coming from customers, retailers, supermarkets, and restaurants because of the availability of alternatives again and their pricing. Now, when looking at their business strategy, they employ both a cost leadership strategy and product differentiation strategy. Through a cost leadership strategy, Coca-Cola aims to price their products lower than their competitors while also trying to maintain low production costs. They do so by managing costs in an efficient manner through economies of scale and cost control. As for their product differentiation strategy, they aim to stand out from their competitors in the beverage industry, and they do so through their brand name, the products they offer, marketing, packaging, and quality. Consumers from all over recognize the Coca-Cola logo, which creates a unique image and sets them apart from their competitors. The company also offers one of the largest varieties of beverage products in the market, and this allows them to cater to multiple consumers with specific preferences. They invest a large amount of money in marketing and advertising, and they maintain the highest quality products, which strengthens the brand name and customer loyalty. Through all these aspects, Coca-Cola's product differentiation strategy allows them to maintain a competitive edge. And now Anna will be discussing the accounting analysis.
So it's very important to find the red flags within the financial statements to be able to foresee issues. It's important to first analyze and observe what factors we should be monitoring and staying ahead of. Within the financial statements between the years of 2018 and 2020, there were significant changes to most areas in the financial statements. Clearly, the changes in cash flow and debt would be one of the direct impacts of the COVID-19 pandemic. A significant decrease in cash reserves may indicate liquidity issues or excessive spending. In this case, it's pretty clear that it's a mixture of those two factors combined with the severity of the COVID-19 pandemic. As we move down the financial statement, the liability section increases from 2018 and on. A substantial increase in long-term debt could likely indicate over-leverage and could eventually pose repayment risks. Between the years of 2018 and 2021, there's a consistent fluctuation. The amount of fluctuation could indicate issues with sales, collection processes, and or inventory management. So to address these red flags, Coca-Cola should focus on boosting revenue growth, reducing debt, and strengthening liquidity. Enhancing cash reserves through better working capital management, tightening credit rules, and controlling inventory is crucial. Refinancing existing debt at lower interest rates and allocating operational cash flow for debt service can also help. Improving revenue through product diversification, market expansion, and enhanced marketing alongside better cost control and supplier negotiations will stabilize gross profit margins. As for net income and adjusted income, the company's performance from 2019 to 2023 changed. Adjusted net income, excluding non-recurring items, is a close match to reported net income, focusing on the stability of the company's operations. This consistency indicates that non-recurring items did not significantly change the company's profitability, which ultimately enhanced the reliability of its financial stability. And next, we'll analyze the financial analysis with Dennis.
So for Coca-Cola's financial analysis, the company did show improvements over the years, and particularly with its solvency, as reflected in the provided financial report ratios in the report. You'll see that the total liabilities to total assets ratio remains stable around 75 to 79%, which suggests that there is a consistent leverage and effective financial model that is being implemented. So this ratio helps with the stability, indicates that the company has maintained a balanced approach to financing its assets and with its liabilities. There was a positive trend that was observed in the total liabilities to total equity ratio, which you'll see that was decreased from 381 in 2019 to 304 in 2023. And this reduction in points, showcases a shift towards increasing equity, equity financing over debt, which strengthens the company's financial base and reduces the overall risk that they have within the company. The long-term debt to long-term capital ratio also showcases a downtrend, moving from 61.7% in 2019 to 60.6% in 2023. This indicates improved management of long-term debt in relation to the company's total long-term capital, also showing that the long-term debt to total equity ratio decreased significantly from 231% in 2020 to 153% in 2023, which shows a deliberate effort to continue to lower the debt dependency and continue to bolster the bottom line, which improves the overall equity of the company. In terms of cash flow, the operating cash flow to total liabilities ratio increased from 25% in 2019 to 37.7% in 2023, which showcases the enhanced ability to generate cash from all of Coca-Cola's operations to make sure that it is able to cover its liabilities. And this improvement is an important factor for maintaining liquidity for Coca-Cola and ensuring that they are financially flexible to be able to maintain operations. The interest coverage ratio, which measures the company's ability to cover interest expenses with its earnings, showcases an uptrend, improving from negative figures to minus 13% in 2013, which showcases a gradual recovery and better capacity to meet, all their debt obligations or interest obligations, which contributes to overall stability, financial stability of the company. And overall, the solvency ratios showcases in general that the company does have successful efforts in reducing its debt reliance. As previous team members have said, that making sure that they're refinancing, trying to get lower interest rates. It helps increasing equity financing and improving cash flow management. And all these positive trends just showcase that Coca-Cola has a stronger and more resilient financial approach, which ultimately will help the companies meet its long-term obligations and make sure that the company continues to stay solvent.
In projecting the future trajectory of Coca-Cola, the analysis suggests a continuation of the historical pattern of revenue growth, with annual rates averaging around 3.5%. This consistent growth trajectory underscores the company's ability to adapt to market fluctuations and capitalize on opportunities for expansion. However, the forecast anticipates a strong profit margin of approximately 15% throughout the six-year projection period, reflecting Coca-Cola's resilience in operational efficiency and maintaining profitability over the long term. As part of the future outlook, the company's earnings per share is anticipated to demonstrate steady growth, aligning with historical data and broader market expectations. This trajectory signifies a proactive and adaptive response to emerging market dynamics, underpinning the company's commitment to sustainable and financial performance. Coca-Cola's strategic approach to capital investment and research development underscores its position as an industry leader positioned for sustained growth and innovation. This forward-looking stance, combined with a robust commitment to strategic initiatives, solidifies the company's long-term prospects for continued market leadership and growth. Leveraging its widespread brand recognition and extensive global presence, Coca-Cola is poised to sustain its prominent role in the beverage industry. By capitalizing on market opportunities and consumer preferences, the company is well positioned to reinforce its status as a trusted and enduring industry leader. In summary, the comprehensive forecast integrates historical performances, emerging industry trends, and the strategic direction of Coca-Cola, the company, heralding a positive outlook for sustained growth and resilience over the next 6 years. All of this helps give good information to help determine how the company is valued.
All right. So as we go into understanding Coca-Cola's financial health and attractiveness, we're also going to talk about the overall valuation. First one will be about the attractiveness as an investment using the dividend-based valuation model. Based on our detailed analysis using the template, we determined that Coca-Cola's value per share ranges from $19.30 to $19.32. This figure is calculated by looking at the discounted present value of expected future dividends that Coca-Cola is projected to pay out to its shareholders over the next 6 years. It's important because it overall tells us how much investors might consider paying today for future dividend payments. And when we compare that to Coca-Cola's current market price, we also notice that there's a significant difference. And this suggests that there may be varying opinions among investors about Coca-Cola's potential. Now, when we move on to the free cash flow valuation model, this gives us another perspective. Based on the financial data, Coca-Cola estimated value per share using this approach comes out to about $38.15. This method involves projecting the cash flow Coca-Cola is expected to generate in the future and discounting them back to their present value. It considers everything from the money that Coca-Cola brings in from their operations to how much they're spending to expand their business and paying off their debt. This valuation helps us see whether Coca-Cola stock is currently trading higher or lower than what they believe is truly worth. Now, the next part, we'll be talking about the residual income valuation approach, where we find that Coca-Cola's value per share is estimated at $19.30. This approach goes beyond just looking at the overall dividends. It looks at the company's overall profitability compared to what investors are expecting to return from their investment. It factors in expected earnings and what shareholders are expected to receive as a return on their investment. This method is helpful for investors because it shows how Coca-Cola is performing against its cost of equity capital, which in return, investors demand for taking the risk of owning the stock. Finally, we consider the cost of equity, which is crucial for understanding what shareholders are expected to earn by holding Coca-Cola stock. According to our calculations, the free cash flow model, and there's a data included in our Exhibit 14, Coca-Cola's estimated value per share is $19.32. Compare this with the current market share, you will see that there's a noticeable difference. This reflects investors' expectations for a higher rate of return than what Coca-Cola is currently showing. To arrive at this number, we looked at different factors that include the risk-free rate, the extra risk that investors are willing to take by investing in their stocks, and Coca-Cola's own market volatility. Understanding the cost of equity helps shareholders decide whether Coca-Cola stock price is too low, just right, or high enough for the potential return it offers. So, to conclude our presentation, we covered a comprehensive analysis of Coca-Cola, highlighting Coca-Cola's overall history and their global presence in the beverage industry. We also dived into their business model, understanding their overall strategic initiatives and marketing position. We presented the overall detailed accounting analysis, which sheds light into Coca-Cola and Coca-Cola's financial statements and the performance. We also discussed their financial performance, including profitability, liquidity, and efficiency ratios, and the overall forecast for Coca-Cola's future financial performance, considering market trends and internal factors. And I concluded with an in-depth valuation analysis using various models that Coca-Cola is using and relative to the current market price. Each of these insights paints an overall picture on Coca-Cola's strengths, their challenges, and their potential opportunities in the market. And this is something that investors can use to analyze to make informed decisions about their investments. Thank you for your attention and participation. And we look forward for you listening about our analysis on Coca-Cola. Thank you.
Thank you.
Thanks.